Hey everyone, welcome in to another daily editorial here on the KE Report. I'm chatting with Brien Lundin. We're going to be talking again about gold hitting that all-time monthly high, but focusing a bit more on the underlying stocks, some of which are continuing to perform well, but many of which I know all of you keep on asking, where's the leverage? When are these stocks going to truly start running like we have seen well over a decade ago when gold was tacking on hundreds of dollars to its underlying price? All very interesting topics, I find, especially in this market. Brien is the editor of the Gold Newsletter, also our host down at the New Orleans Investment Conference, this year happening November 20th through the 23rd. I'll post a link to the conference below this interview. Brien, gold recently closed at an all-time monthly high. It continued even higher today, up to about that $2,500 level. Bit of a discrepancy we're seeing on the futures compared to the spot market as the futures contract rolled over to December, and that's providing a bit of an extra boost as we're seeing something like silver give back some of its gains today that it had yesterday. Brien, what's your takeaway from just how strong gold is in the face of some other metals still more or less trending sideways, I guess we can say?
Yeah, the interesting thing to me is that it's hard to believe, but somewhat quietly, gold has gotten to these levels that we wanted it to be at, not just last year, but just a few months ago. I mean, gold's gained over $400 this year so far. And as a consequence of that, a lot of these companies that had big resources that we always thought of, they occupied that category of out of the money gold optionality plays. Big resources that just needed a higher gold price before they would become economic to develop. And suddenly we are at the levels where these out of the money optionality plays have suddenly become in the money optionality plays and well in the money, actually achievable at current gold prices. And I think this is a development that the market has largely overlooked. These companies have not been yet repriced for the current gold price environment. That's going to happen if we keep these levels. And I think we are. And frankly, I think we're going higher from these levels. So that's going to happen. It's just amazing to me when I look at these pitch decks for companies and they'll show their projects economics and they'll show the sensitivity to the gold price and they'll show what at the time was the PEA or the PFS or whatever they did. They'll show at the time what was a far higher gold price and how that affects the economics. And the fact of the matter is the gold price today is well off the charts, well off the scale of any of those gold price sensitivity charts. I have not seen one that showed what the economics of their project would be at $2,400 gold because it would just seem incredible at that point in time. But the fact is we're there. So I think there's a lot of opportunity in those kinds of plays.
So, Brien, let's talk about the leverage that these gold stocks have offered to the underlying gold price. You're right, the gold price up around, let's say, $400 this year. However, you look at some of the majors have done pretty well this year, except if you look, it all depends down to what time frame, right? You look at something like Newmont, the bottom of the chart this year in about the beginning of March, that's up 60%. But from the beginning of the year, it's only up still about 20%. GDXJ, that's up around 35%. So it's offered a little bit of leverage to the underlying gold price, but this isn't the type of leverage that investors are looking for. So what is holding back even the biggest of the gold stocks from leveraging that underlying gold move?
Yeah, it's the generalist investors coming in, frankly, because that's the big pool of money that'll make a difference in the sector. And you don't need much of an allocation shift into the sector to get big moves from these huge pools of capital that are sloshing around the world's markets. And I think that's coming. I think two things are going to really spark that, and I think it's happening right now. The first are the quarterly financials for the gold producers, which are showing some really nice numbers. The ASICs have gone up, but over the last quarter, the gold price has risen far more quickly than mining costs have, and energy prices have remained somewhat subdued. So that's such a big component into OPEX for the miners. And that's really helped numbers this quarter. So the market can't ignore those numbers. Those are coming out right now. The other thing is that the theme for investing in gold has switched from one that the market could not have confidence in, that being central bank buying and Chinese domestic buying, to a Fed pivot. That's the kind of a factor that investors can look ahead and say, well, for the next 2 or 3 years, we are going to have a much more accommodating Fed and other central banks. We are going to have easier money policies. And in that kind of an environment, we want to be or shift our allocations somewhat towards metals and miners. So those two factors, I think, are happening literally as we speak.
So, Brien, what do we need to watch? Is it simply the action in the majors? Do you think that we should look at volumes in something like the GDX to show that other money is coming in? Or do we even need to go down to something like the mid-tier miners that have better ASICs? They don't generate nearly as much cash flow as the majors, but they do have better margins. Could those lead a charge of new money coming into the sector?
Well, I think we'll see a response across the board initially in the bigger miners. And we're starting to see that. Agnico Eagle's been doing very well as well. So I think that initial response will be in those majors, and then they'll go further down the food chain. That's the way it typically happens. But if you're looking at, from an investment standpoint, if you're looking to get torque in the junior sector or in the mining sector in general, I think those companies with big resources, the ones that may have been thought of as optionality plays to some degree, I think some of those are where you want to be right now. They offer the potential for 4 to 5x gains, which would be something you might expect for a grassroots discovery play. And you get that with much less risk assumed because they have already found something.
Agnico has done well this year to date, up about 37%. But again, from that low at the very beginning of March, that's up almost 70%. So again, it has offered some leverage to the gold price, and really depends when you cherry pick your time frame with that as well. Brien, what do you look for in an optionality play, though? Because in all fairness, it seems like almost every company out there has at least 1 million ounces of gold resources, or let's say 50 million ounces of silver, 20 million ounces of silver. But look, we all know all these ounces are different. They all carry different risks and different costs with them. How do you go about isolating some of the best optionality plays?
Yeah, well, you want something that the majors would be interested in. In that regard, you're looking at the cream of the crop will be something 2 million ounces or above, probably more along the lines of 5 million ounces or above. And there are some out there. You want to look at achievability. If you look at their economics with prices where they are now, just about everything is economic. But for these big projects, you need to look at IRR. If the IRR is 20, 25% or higher, that's something that's going to pique the interest of a major much more quickly than something that's below 20 or 25%. You want to look at CapEx. If you're talking billions of dollars of CapEx, then that's going to be not the first projects to go off the board. But everything has to be in context. If a project can be staged into production, that's something you want to look at. There are a couple of companies out there. I'd say a couple. I'd say there's probably 4 or 5 out there that are very high profile that you want to look at. I don't want to mention any names because a couple of them are on my short list right now for recommendations. And this month's gold newsletter coming out today as we speak, I got a new recommendation of one that's very high profile, but is extremely exciting. And it literally has just become achievable in my mind.
Does it matter to you that some of these projects have been around for well over a decade? Do you care about when they were discovered and how long they've been in the market?
Not really. I think you have to get beyond that old story, been around kind of cachet for some of these companies. But any project that's got 5 million ounces or more realized and circumscribed by drilling and some economics applied to it has by definition been around for a while. I think what we're looking at is everything's a new story at $2,400-$2,500 gold. I don't think the market has come to realize the new world that we have entered at $2,400-$2,500 gold. The vast majority of identified projects are easily economic at these prices. Now, again, construction costs have risen. Inflation has raised the capex for a lot of these projects. But the gold price has exceeded, the rise in the gold price has significantly exceeded the cost of constructing a mine over the last quarter or two and the cost of operating a mine. So it will take some time for the markets and investors and investment banks to get comfortable at these new levels for gold and get comfortable with the uptrend for the gold price. That's a process we're going to go through, but you don't want to start investing in these optionality plays, these previously optionality plays. At the end of that process of acceptance, you want to be investing in them before the market comes to realize what has happened.
So, Brien, just a quick comment on the market then. We have seen a comeback in some of the Magnificent Seven names. Tech has faded down. However, we've seen a lot of that money flow into the small caps. Can you make the argument that some money has flown into the gold stocks? And if so, or if not, is a market crash, a market correction, a major market move downward what the gold stocks need for more money to come in?
Yeah, if you look at the performance of the GDX and the GDXJ, it's hard to argue against the fact that some money has come in. So I do think we're seeing the first stirrings of that generalist investor move into the metals. We'll see what happens, see if it'll become a flood. But at some point, the markets cannot ignore the value in the gold miners, can't ignore the kinds of cash flow being spun out. And, the miners over the last 10 years or so have shifted their strategy somewhat toward dividends as opposed to capital appreciation, share price appreciation, because they were being ignored by the market. That's kind of a fail-safe for them when they start spinning out this kind of free cash flow, to start giving the market those kinds of dividends. And that will bring generalist investors in, the value investors in, if not the more speculative investment segments.
All right, Brien, we'll wrap it up here. Always fun chatting with you. And now even more of a look into those optionality plays. Look, they're in this market. There's a number of them, so you do need to go in and really dissect what you're looking for in an optionality play. But you are right. At these higher metals prices, it looks like almost all of these projects work. We all know, being in this sector, that not all of these projects work. Very few of them actually will work out, but there can be an opportunity to make money for many investors. You just need to be in the right ones, and honestly, you just need to time it very well. Brien, thank you very much for your time. We'll chat again in another couple weeks.
Thank you.